Hello and welcome to Chapter 12, the Statement of Cash Flows. This is our final chapter of the semester. We're almost there to the end. So let's go through and start talking about the cash flow statement and why we care about it. It's one thing for a company to generate income, but that income eventually needs to be converted into cash. If the company is unable to convert their income into cash flows, they're not going to last very long. They need cash to pay dividends to owners, to expand operations, to take advantage of investment opportunities, to replace assets when they're worn. Basically, a company needs cash to do anything, just like you or I do. Eventually, we need cash. We could swipe our credit card for a while, but eventually we're going to have to pay that credit card. And to do that, we're going to need some type of cash flow. A lot of Wall Street analysts consider it the most important concept to determine whether a business is doing well or not. So not focusing just on net income, but the company's ability to convert that net income to cash is an important tool in assessing the financial health of the company. So what is cash? Cash includes cash and cash equivalents. Cash equivalents are short-term, highly liquid investments that are both readily convertible into known amounts of cash and so near maturity that there's little risk that their value will change if interest rates change. Generally, only investments with original maturities of 3 months or less qualify as cash equivalents. So cash is like money you have in the bank in your checking account or savings account, or short-term like certificates of deposit would be considered a cash equivalent. Or you could have like a very short-term investment in treasury bills or something like that. That would also be considered cash equivalent on the financial statements as opposed to an investment. Remember from the very beginning, Chapter 1, my friends, we talked about the 3 categories of cash flows: operating activities, investing activities, and financing activities. Operating activities are the cash inflows and outflows directly related to earning from normal operations, which means they're cash flows related to our revenues and expenses. Investing activities are the inflows and outflows related to the acquisition or sale of our long-term assets. So investing activities deal with cash flows related to our long-term assets. And then our financing activities relate to the 2 ways we finance our business, which is debt and equity. So these are going to relate to the cash flows related to our long-term liabilities and our equity. And we'll talk more about what goes into each category as we progress, but at this point, this should seem relatively familiar to you. What are we in the operation to do? To make a profit, so revenue or expense related cash flows go there. How do we make a profit? We have to invest in our business to grow it, so long-term asset activities is an investing section, cash flow. And then finally, how do we finance all of our growth? Assets are financed with debt and equity, so long-term debt and equity are considered our financing activities. Here's a cash flow statement for National Beverage Corp. You can see that they have their 3 sections: operating, investing, and financing. And you may ask yourself, well, why do we need a cash flow statement? I know how much cash the company has if I look at the balance sheet. And my answer to that is, would it be more impressive to you if you found out that I had $100,000 because I borrowed it from the bank, or because I had $100,000 from earning it over time? And I think you'd say earning it over time would be more impressive because I don't have to pay that back like I would a loan. So that's what the cash flow statement is telling us. It's not done or prepared to get that ending cash balance that shows at the bottom. It's done to show us how we went from the beginning of the year balance to that ending balance. What created the change in cash during the period? Because it's important to understand what caused the cash to change. Was it because I earned a lot of cash from operations, which is the case for National Beverage, or was it because we borrowed a lot of money? With National Beverage, I could see that they generated over $110,000, and that's in thousands, so it's really over $110 million in cash flows from their operating activities. They used about $13 million for their investing and then they paid off, looks like, a large amount of cash dividends, which is why their financing cash flows are negative. So this really gives us a much better picture to understand what happened to a company's cash during the period. There's two formats for reporting cash flows from operating activities, the direct and indirect method. You may remember in a lot of the chapters there was sections on cash flows and it talked about net income plus or minus something, and I always said, well, we'll deal with this later. Well, guess what, friends? It's later. That's the indirect method. The indirect method starts with net income and then converts that net income to cash flow. Remember, net income doesn't equal cash because revenues are recognized when earned, not necessarily when cash changes hands, and expenses are recognized when used, not necessarily when paid. So that's why there'll be a difference between net income and cash flow. The direct method is easier to understand, but a little more challenging to prepare in the real world. It's easier to understand because it directly tells you where the money came from and where it went to. So it'll tell you the cash we receive from customers is $100,000, the cash we paid to our employees is $50,000, the cash we paid for insurance is $10,000, and so on. It's very easy to understand, but it's a little more challenging to prepare. Either way, whether we use the direct or indirect method, we'll arrive at the same answer for cash flows from operating activities. So a company can choose either method in preparing their cash flow statement. So again, the cash flows from operating activities are always the same regardless of the method that's used. And we're going to learn how to do both methods. So to recap what goes into each section, our operating activities are going to be the inflows and outflows related to revenues and expenses. So some examples would include cash received from customers or from dividends and interest on investments. Dividends and interest get screwed up by students a lot because they want to call that an investing activity. Because the cash we receive for dividends and interest on investments relates to revenues for the business, it's an operating cash flow. On the outflow side, we have cash paid for services like electricity, rent, insurance, etc., and goods for resale, like the stuff we buy to resell, the inventory purchases. And then we have salaries and wages and income taxes and interest on liabilities. Interest paid is another one that gets messed up. Interest paid relates to interest expense, so that's going to be a operating cash flow, not a financing cash flow where some students like to put it. So please be aware that the most common screw-ups for the operating section are dividends received, dividends received, interest received, and interest paid. These all belong in the operating section, but students tend to try to put them in other sections. Because they relate to revenues for the received and expense for the paid, they are part of the operating section. You might think that dividends paid should also go here to kind of finish the whole dividends received, dividends paid thing, but dividends paid don't belong in the operating section because dividends are not required, therefore they're not an expense. So dividends paid, that is, ends up in the financing section because we pay them to our owners, which is part of equity, which goes in the financing cash flow category. Investing examples include the sale or disposal of property, equipment, and other long-term assets, the sale or maturity of investments in securities. Obviously, investments are investing activities. Cash paid for the purchase of those long-term assets, property, plant, equipment, etc., and the purchase of investment securities would be outflows related to the investing section. Financing relates to long-term debt and equity, so this would be the borrowings on notes, mortgage, bonds payable, as well as issuing stock to owners. That'll all result in cash inflows. Then when we repay back that principal on those loans, that'll be an outflow. Repurchasing stock, remember treasury stock, that's another outflow. And then dividends paid, that's a common one that people screw up. Dividends paid belongs in financing, because again, dividends are not expenses because they're not required, so they can't fall in operating. So we put them in financing because they're paid to owners. And in the financing section, debt and equity transactions belong here, and equity is where the owners are. The goal of the cash flow statement is to show us the net increase and decrease in cash. So we have our three sections added together. That tells us why cash changed during the period, which then allows us to determine the ending cash balance, which would show up on our balance sheet. Again, the goal isn't to calculate the ending cash balance. We already know what that is. It's the amount on the balance sheet. It's to really figure out why that balance exists. And then we can have one perk of double checking our work, because if we did the cash flow statement correctly, the ending cash balance on the cash flow statement should equal the cash on the balance sheet. So that is one way we can double check our work. In order to prepare a statement of cash flows, we need comparative balance sheets, because we're going to be working on the changes between our current assets, current liabilities, long-term assets, and long-term liabilities to figure out the cash flow statement. We're going to need an income statement, because a lot of the steps involve converting net income to cash flows, and then we're going to need some additional details that would be provided in any problem that we're asked to compute. The cash flow statement is really derived from the balance sheet. And basically what that means is the change in cash is the result of the change in everything else on our balance sheet, which is the change in our liabilities, the change in our equity, and the change in any non-cash assets. So we take our change in liabilities plus our change in equity minus any change in non-cash assets, and that would give us our change in cash. So in short, all you really have to understand about this is that when we're done our cash flow statement, we will have explained every single change on the balance sheet. That's how we'll know we're done. So looking at a comparative balance sheet, we can go through each item and determine where it's going to show up. Obviously, the cash and cash equivalents, that change, that's really the end finale. That's the end game. That's what we're trying to solve for. How are we going to do it? By figuring out how the change in every other asset, liability, and equity account affects the cash flow. Short-term investments would affect investing. All of our current assets are going to affect operating. So with the exception of the investments, all other current assets affect the operating section. Long-term assets affect investing. Current liabilities affect operating. And long-term debt and equity affects financing. Retained earnings, you can see, has an O and an F, because remember, as part of retained earnings, we have net income. That's an operating section activity. And then the remainder, which is dividends, is a financing activity. And then, of course, we need net income on our income statement, because when we're using the indirect method, we're going to start with that amount to do our conversion from the accrual net income to cash flow.